China just did something unprecedented. Without a single announcement, without a press conference, without warning, Beijing quietly severed nearly $1 trillion in financial ties with the United States. Wall Street woke up to find the money tap turned off. And honestly, most Americans have no idea what's coming next. There's a financial earthquake happening right now, and it's unfolding in complete silence. For decades, Chinese capital flowed freely into American businesses. From Hollywood studios to Silicon Valley startups, from real estate developments to manufacturing plants, Chinese investors poured hundreds of billions into the U.S. economy. It was a relationship both sides benefited from. American companies got funding. Chinese investors got returns. Everyone went home happy. That era just ended. Beijing hasn't issued a formal statement. There's been no dramatic press conference, no ambassador recalled, no hotline disconnected. But make no mistake, China has made a calculated decision that will reshape the American economy in ways we're only beginning to understand. And here's what makes this truly alarming. This isn't about tariffs or trade deficits or intellectual property theft. This is about something far more fundamental. This is about money itself, the lifeblood of capitalism. The fuel that powers everything from your local businesses to the largest corporations on Earth. China has turned off the tap. And, honestly, the ripple effects are already spreading through the American economy like cracks in ice. Let's start with what actually happened, because the full story only emerged through careful analysis of regulatory filings and confidential sources. Sometime in late 2025, China's Ministry of Commerce made quiet adjustments to overseas investment regulations. The language was bureaucratic and technical, the kind of policy update that rarely makes headlines. But buried in those revisions was a directive that changed everything. Immediate cessation of capital flows to countries designated as unfriendly. The United States now sits squarely in that category. Then, on November 17, 2025, China's Foreign Exchange Authority issued internal guidance to financial institutions. The message was clear and unambiguous. Stop funding to American companies. The justification cited political instability and potential risks to Chinese assets abroad. No public announcement was made. No official explanation given. The decision became visible only through regulatory disclosures that Reuters later confirmed through multiple sources within China's financial system. But here's the thing, this wasn't a sudden pivot. The groundwork had been laid for years. Consider the numbers. Back in 2018, Chinese investment into the United States peaked at $46 billion. That same year, trade tensions were escalating, and both countries were locked in an increasingly hostile relationship. By 2024, that investment figure had collapsed to just $2.3 billion, according to research from the Rhodium Group. Think about that decline for a moment. A 95% drop in just 6 years. And now, even that tiny remaining trickle has been cut off entirely. Professor Jia Dajing from Tsinghua University describes this strategy as applying financial pressure without triggering an all-out economic war. It's calculated, precise, and honestly, devastatingly effective. What makes this particularly concerning isn't just the money China is withholding. It's where that money is going instead. While trade between the U.S. and China continues, ships still cross the Pacific, goods still move through ports. Beijing is methodically extracting itself from America's financial architecture. The evidence is everywhere once you know where to look. In 2025 alone, China reduced its holdings of U.S. Treasury bonds by $14 billion. That's the steepest annual drop in nearly a decade, bringing total Chinese holdings down to $689 billion. To put that in perspective, China used to be America's largest foreign creditor. Now it's steadily backing away. But it goes deeper than Treasury holdings. Major Chinese state banks have stopped clearing dollar transactions with American institutions. New compliance standards set by the People's Bank of China effectively cut the plumbing that allowed money to flow smoothly between the two financial systems. Former U.S. Commerce Secretary Gina Raimondo warned that these developments are fundamentally weakening Washington's ability to influence Beijing. Traditional tools like tariffs and export restrictions simply move too slowly to counter this kind of capital retreat. And sanctions? They've only accelerated China's pivot toward alternative partners. Beijing is now deepening financial relationships with Saudi Arabia, Russia, and even portions of Europe. Companies in these regions are actively exploring payment systems and investment channels that bypass American dominance entirely. The imbalance in financial leverage isn't some future threat. It may already be locked in. And inside the United States, the consequences are becoming impossible to ignore. Foreign direct investment into the United States dropped by 22% in 2025. Chinese capital was notably absent, but, they weren't alone in pulling back. Norway's massive sovereign wealth fund exited $7.1 billion worth of American technology holdings, citing regulatory instability as a primary concern. Japan's government pension investment fund trimmed its exposure to U.S. commercial real estate by 30% after a series of credit downgrades hit regional banks. These aren't minor adjustments. These are major institutional investors sending a clear signal: something has changed. Here's where it gets really concerning for American businesses. $4.1 trillion in corporate debt is coming due by the end of 2026. That's honestly an enormous amount of money that needs to be refinanced. Under normal circumstances, companies would have multiple options: domestic banks, international investors, capital markets. But with foreign investors pulling back, American companies are being forced to rely almost exclusively on domestic funding sources. And domestic funding comes at a much higher price. This isn't just an inconvenience for large corporations with deep pockets and financial flexibility. Mid-sized companies are getting crushed. As equity funding dries up and traditional bank lending becomes more restrictive, businesses are turning to high-risk borrowing just to survive. In 2025, companies issued more than $430 billion in high-yield bonds, essentially junk bonds. That's a 38% increase from the previous year. The average interest rate on those bonds? 9.6%, nearly double what companies were paying just 3 years earlier. Let me give you a concrete example of what this looks like on the ground. Hartwell Tech, a Boston-based firm with solid fundamentals and a promising product pipeline, had a $180 million financing deal lined up with Chinese investors. The deal was structured, the terms negotiated, the paperwork nearly complete. Then, with virtually no notice, the deal vanished. The Chinese investors simply walked away, citing new regulatory constraints. Hartwell Tech was left scrambling. They eventually secured emergency funding from Apollo Global Management, but at an 11.3% interest rate. To get that funding, they had to pledge their intellectual property and real estate as collateral. That's not financing, that's desperation. Credit rating agencies are sounding alarm bells across the industry. Fitch now estimates that roughly 20% of mid-market American companies face serious refinancing risks within the next 18 months. Many are accepting financing deals that ensure short-term survival, but fundamentally weaken their long-term prospects. And it's not just private companies feeling the pain. Remember all those ambitious plans to bring manufacturing back to America? The promise of revitalized industrial towns, new factories, jobs returning from overseas? Well, those plans are colliding hard with financial reality. President Trump's 2025 executive order expanded tax incentives designed to promote reshoring and strengthen domestic supply chains. On paper, it looked transformative. In practice, it's running into a wall. The National Association of Manufacturers reports that nearly 2/3 of companies planning American expansions are now facing significant financing shortfalls. And the primary reason? The absence of foreign investment partners who traditionally helped fund large-scale industrial projects. Major announcements made just a year ago are now being quietly postponed or abandoned altogether. An $8 billion battery manufacturing plant planned for Michigan? Delayed indefinitely. A $3.1 billion robotics center in Nevada? Shelved. And perhaps most symbolically, Intel's $20 billion semiconductor facility in Ohio, promoted as proof of American technological self-reliance, has stalled its second construction phase after running short of funding. Economist Eswar Prasad told Bloomberg that these projects cannot deliver meaningful economic transformation unless they attract a broad and stable mix of capital from multiple sources. Without that diverse funding base, they risk becoming political symbols rather than engines of genuine long-term growth. The harsh truth is that rebuilding supply chains domestically costs far more than anyone anticipated, and the ambition to reshore production is running directly into the reality that capital is scarce, expensive, and increasingly unavailable. The consequences aren't abstract. They're about to hit American consumers directly in their wallets. Tariffs imposed by the United States now cover more than $500 billion in Chinese imports, up from $370 billion just 5 years ago. According to the Peterson Institute for International Economics, average tariff rates are hovering near 22%. Those costs don't just disappear, they get passed along. Electronics have gotten significantly more expensive. Household appliances jumped nearly 17% year over year. Auto components, furniture, clothing, all seeing price increases that trace directly back to tariff policies. Analysts estimate that by the end of 2025, the typical American household spent close to $2,000 more on everyday goods compared to the previous year. $2,000. That's not a rounding error. That's a real financial burden on families already struggling with inflation and stagnant wage growth. Businesses are feeling this squeeze from both directions. S&P 500 companies saw profit growth slow dramatically, falling to just 1.2% in the fourth quarter, from 4.5% the previous quarter. Corporate leaders face an impossible choice: absorb rising costs and watch profit margins evaporate, or pass those costs to consumers and risk killing demand. With wage growth essentially flat and inflation still running above 3.6%, raising prices threatens to choke off consumer spending while simultaneously pressuring corporate balance sheets. The result? Economic uncertainty has surged to levels not seen in more than a decade. The Economic Policy Uncertainty Index shows that the final months of 2025 were more volatile than the COVID shutdown period of 2020. In fact, they even surpassed the uncertainty seen during the 2008 financial crisis. Let that sink in for a moment. We're living through more economic uncertainty than the Great Recession. A combination of tight monetary policy, unpredictable fiscal decisions, and inconsistent trade strategies is destroying confidence. The Conference Board's CEO Confidence Index dropped to 37 in December, its lowest reading since mid-2020. Nearly 70% of executives say unclear government policies are preventing them from planning effectively. Bank of America analysts argue that the investment slowdown isn't primarily about high costs. It's about confusion and lack of clear direction. When business leaders can't predict what policies will look like 6 months from now, they stop investing, they stop hiring, they stop taking risks, and investors are responding accordingly. More than $120 billion exited U.S. equity ETFs over a 3-month period in late 2025. That's not normal market volatility. That's a massive vote of no confidence. Many economists believe this trend reflects something deeper than a temporary shock. It represents a fundamental loss of faith in the stability and predictability of the American economic system. And here's where things get truly worrying. America's closest allies are starting to adjust their expectations. If major Democratic partners begin looking for economic stability elsewhere, Washington's ability to set global economic rules will weaken substantially. Multinational corporations will increasingly seek out markets and systems that offer greater predictability. That shift isn't hypothetical, it's already happening. In November 2025, Germany's chemical giant BASF announced a $10 billion expansion in China. The announcement came shortly after Chancellor Merz concluded talks that included a joint agreement on energy technology cooperation. Around the same time, France's finance minister Bruno Le Maire finalized a long-term liquefied natural gas deal priced in yuan, completely bypassing the US dollar. European investment into Chinese industrial zones climbed 19% in the fourth quarter alone, with investors explicitly citing predictable policy environments as the key attraction. Even Saudi Arabia, a traditional U.S. ally, has begun reducing its reliance on American assets. The kingdom recently committed $27 billion to an artificial intelligence development fund backed by China and Singapore. Former IMF chief economist Kenneth Rogoff argues that American power isn't disappearing, but its ability to anchor the global financial system is weakening. Allies aren't turning against the United States. They're hedging. They're protecting themselves from instability. China, by contrast, is positioning itself as a source of consistency and predictability. And that consistency isn't accidental. China's recent pause in outward investment may represent just the opening move in a far broader strategy to redirect global capital flows. The goal appears to be gradually draining momentum from U.S. markets while systematically reinforcing economic ties across Asia and beyond. The evidence suggests careful, deliberate planning. Chinese regulators fast-tracked 38 foreign company listings in Shanghai and Shenzhen during the fourth quarter of 2025, a jump of more than 50% from the previous period. These weren't minor firms. These were substantial international companies choosing Chinese markets for capital raising. Simultaneously, China's sovereign wealth fund quietly increased its holdings of ASEAN debt by nearly $19.5 billion. That's money flowing into Southeast Asian bonds rather than American assets. But perhaps the most consequential development is the rapid expansion of China's digital yuan, now connected to streamlined settlement systems in 13 countries. These systems enable cross-border transactions without touching the US dollar at any point in the process. HSBC analyst Harold Wang notes that Beijing isn't trying to overthrow dollar dominance overnight. That would be too aggressive, too risky, too likely to provoke a severe American response. Instead, China is building parallel financial infrastructure so that using the dollar becomes a choice rather than a necessity. Think about what that means in practice. If a Malaysian company wants to buy goods from a Thai manufacturer, they can now settle that transaction in digital yuan through systems that are faster, cheaper, and completely independent of American financial oversight. No SWIFT network, no correspondent banks in New York, no exposure to U.S. sanctions policy. As confidence in American financial leadership erodes, and the data suggests it is eroding, capital may shift abroad gradually and quietly. Not through dramatic confrontations or headline-grabbing announcements, but through simple, rational reallocation. By the time Wall Street fully grasps what's happening, much of the money may already be gone. If China succeeds in steadily redirecting investment flows, reshaping global liquidity channels, and redefining the basic norms of international finance, the balance of economic power could shift faster than anyone expects. This pause in investment may be only the first step in a transformation that fundamentally alters how the world economy functions. The larger question isn't whether China can challenge American financial dominance. The question is, what happens if China persuades U.S. allies to conduct trade entirely outside the dollar system? Such a transformation wouldn't be enforced through political pressure or military might. It would happen through numbers, through spreadsheets, through the quiet decisions of finance ministers and corporate treasurers choosing systems that work better for their needs. And it would permanently alter the foundations of global finance. We're watching something unprecedented unfold. Not a financial crisis in the traditional sense, but a slow-motion restructuring of the economic order that has defined the world for decades. The money is moving. The question is whether anyone in Washington is paying close enough attention to understand what's actually at stake.